Hey everyone, welcome to the final bar. Today, my guest is Chris Ciovacco from Ciovacco Capital Management, giving us a preview of his market outlook presentation coming up later this week on StockCharts TV. The S&P is sort of choppy today, sort of a mixed bag of movement, although certainly finished net higher. The interesting story, though, is some of the FANG names rolling over, continuing that pullback, while the leadership today was industrials, energy, financials, materials, bit of a rotation today. So what does that mean for the long-term trends and the breadth picture? We'll get today in the show. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller, here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for the show. Try to make sense of these markets together, look at the charts, review some of the signals, the patterns, where the movements are coming from, what's working, what isn't. Most importantly, connect what we're seeing today with the longer term trend. The survey that we asked recently, the poll question was what time frame people operate on. And again, I find it so easy, especially in a choppy market, in a volatile market where there are a lot of quick news. There's news flow that causes quick movements. It's very easy to get sucked into the short term picture and have a short term approach to how you consume information, how you think about things. And I hope one of the goals of this show is to try to reflect on what we're seeing today, but really connect it to the long-term trends, look at the long-term trajectory, which is why this week is really special on StockCharts TV, focusing on the second half of the year, really focusing on a long-term outlook. So I'm excited to hear from Chris Ciovacco today to get a preview of what he's thinking of the next 6 months and where we should be thinking as investors. Now, on the calendar for the coming days and coming weeks, as I mentioned, charting the second half is running all this week. We've had so many fantastic presentations. I was watching Linda Raschke's market outlook presentation last night. Martin Pring's was really good. We have Ralph Akampora's coming up this week as well. It's been really cool to hear what everyone is thinking, what their toolkit is telling them, and I'm finding it's helping me reflect on my own process, my own conclusions. Mary Ellen McGonigal is going to be joining us on the show tomorrow, giving a preview of her presentation. This Saturday is a very special live interactive Q&A market outlook panel with a group of StockCharts contributors. I'll be moderating that discussion. We had a great debate earlier this week on how we were going to approach it. I'm really excited to present it to you. It'll be interactive, so you'll be able to ask questions of the panelists during the presentation. Then next week, we will keep the good things coming. John Markman is going to join us from Markman Capital Insights on Behind the Charts. That's on Monday, hearing his approach to analyzing the market. And then Andrew Thrasher will join us on the 21st. So we've been so blessed to have some great guests on the show and on StockCharts TV. And Chris Ciovacco coming up a little later is one of my favorites to talk to. Has a great long-term perspective on things. Let's get to our market recap and focus on what we saw today. So, in my conversation with Ralph Akampora, we talked a lot about leadership rotation and looking for where there might be opportunities and focusing in particular on where the rotation was happening, a rotation away from mega cap tech and into other places. It's interesting today that we actually saw a bit of that. You saw small caps lead the way higher, up 3 2/3%, mid caps up 3%. This is when the S&P finished up, finished higher, but just below 1%. It was 0.9% higher to 3226 and change. So the market finished higher. It was the MEI, the late cyclical leadership, leading higher, as well as financials, all up, about 2% or more. The laggards for the day were technology, real estate, consumer staples, and utilities. So a bit of a rotation, a different configuration that we've seen from sector returns than usual. The VIX lowered today, back below 28 now. Interesting to note, the tech-heavy NASDAQ 100 actually flat for the day, up 0.1%, which is a minimal gain, but sort of chopped around the zero line for most of the afternoon. Bonds actually finished lower today. They gapped down pretty good at the open, rallied into the midday and finished weaker, and the dollar weaker as well. That weaker dollar story is something we've talked about. The poll question we have going on right now on StockCharts TV, as well as some of our other avenues, relates to thinking about non-U.S. stocks. So I'd encourage you to answer that poll question. Think about how you are thinking about international or non-U.S. stocks. Gold flat for the day, finished actually pretty low, but rallied to finish more toward the highs of the day, which is actually a pretty impressive recovery from where we started. And oil prices a little higher as well. Let's look at a chart of the S&P 500, focus on what's happening. So what we've been talking about for a while now is this range-bound configuration. Again, I go back to my conversation with Rick Bensinger earlier this week, thinking about, people love to, go into one of two buckets. You're either bullish or bearish, and you think the market's going to rip past 3,400 to go even further, or you think the market's going to retest the March lows. And we love to bucket people into extremes. You're either super bullish or super bearish. And his comment, which I think makes a lot of sense, is the action of the market should suggest more of a range-bound thesis, right? There are plenty of mixed signals to suggest that we're in a bit of a holding pattern. I think just the price action over the last 6 to 7 weeks certainly backs that up with a clear resistance level we keep bumping up to. We did that earlier this week on Monday. Today, we're right back up to that resistance around 32.30 or so. That's the high from the first week in June. So potentially, we'll have to see if this resistance holds going into tomorrow through the rest of the week, or if we break above. And as I've said for a while, you have to take a step. If you take a step back, if you look at the weekly chart of the S&P, it's a very clear pattern of higher highs and higher lows. As we keep breaking resistance, you have to assume that trend is going to continue unless you get information proving otherwise. And what I've seen with weaker breadth, what I've seen with bearish divergences, those are the leading indicators that tell me we're in the later stages of a bull run, but it's not telling me that the trend is over yet. That's what I would wait to see, some sort of breakdown. Every time we've gotten an opportunity to get a breakdown, we certainly haven't had it. The RSI is back above 60, which keeps it in that sort of bullish range overall, suggesting, again, the uptrend continues, the uptrend persists until proven otherwise. Elsewhere, looking at just some of the returns for today, some of the groups that led the way higher. Airlines actually up big again, so we are back to the incredible volatility of airlines. I feel like we'd sort of gotten away from that for a little bit, which was good. But the group up over 10% today, and again, a lot of news flow related to airlines, a lot of speculation about closing and reclosing of the economy, just thinking about how this might play out. But certainly a bid coming in today for airlines, for gambling, for travel and tourism. These are all groups related to, certainly more of an aggressive reopening or a more successful reopening than we may have expected, or that we may have feared wouldn't happen. Hotels in one of the top 10 groups as well. So 5 of the top 10 are in consumer discretionary, which is actually an interesting thing. The consumer discretionary sector not up dramatically, and I would say, for me, I think a big part of that is Amazon. Amazon's obviously a huge weight in consumer discretionary. So what you have to remember, this is why I'm bringing this up today. If you look, half of the top 10 industry groups were in consumer discretionary, which makes it feel like great day for consumer. But if you look at consumer discretionary, the sector, sort of flat, up a little bit more than the S&P, but essentially middle of the pack of the 11 sectors. Remember how big of a weight some of these mega cap stocks are. So if you just look at the cap weighted movement of these sectors day to day, week to week, you're missing out on a lot of the signal that comes from going one level down, which is why we try to focus on Fridays, on Mondays, sessions like shifting stocks, where we focus on groups and themes and individual names that are fluctuating. There are opportunities out there, and it's a really good time to, maybe reevaluate some of the screening tools you are using to try to identify some of the signals out there. Elsewhere, looking at the downside, what was leading the way lower? Broadline retailers, which is also one of the consumer discretionary groups. This is Amazon's groups, down 2% today. So certainly that's the balance that you see, one of the biggest cap groups at the bottom of the list, other ones toward the top. Interesting to see the internet group flat for the day, but again, underperforming today. Semiconductors flat for the day, but underperforming. And that performance of the semiconductor, to look at the SMH here, it's a pretty key group to pay attention to. The relative strength of this group has been consistently positive, and that's one thing I would remind everyone in terms of the long-term trajectory. I think we're seeing bearish divergences in a lot of tech, and in the SMH you can see that with higher highs in price, with lower peaks in the RSI. So that's a bearish divergence. The relative strength overall has been positive. It's come off in the last week, but again, that's 1 week within a 1 year long plus trend of outperformance. This group has been outperforming since, well before 2020. The group was actually doing well, which overall speaks to, internal market strength, and that group is doing well. But the bearish divergence, the bearish engulfing patterns that we saw in a lot of these names earlier this week, suggest short-term weakness. But again, you want to see, is there some sort of break in trend? So on something like semiconductors, until we get a lower high, until we get a lower swing low, right, we start to reverse this pattern of higher highs and higher lows that we've seen. Until that happens, overall, the trend, I think, remains overall fairly positive. So you want to pay attention for sure there in terms of anticipating a reversal, but identifying when a reversal actually happens. Financials up, in the upper half, and I think it's interesting to look at this group. So the XLF has rebounded from a key level of support. This is the 38.2% retracement level. This is based on February to March being the big sell-off. We then retraced just over 61.8% to the 200-day moving average. It came back to now test support at that 38.2% retracement level, which was the upper end of this gap from mid-May as well. We've now bounced back above it, and we're about the 50% level, or halfway between the February to March sell-off. So a nice week actually so far, building on the uptrend we started last week coming off support. The question is, do we able to continue that? And if financials continue to appreciate, we're keying in on sort of the ultimate line in the sand, that resistance level around 25.70 to 26, which would be the Fibonacci retracement level as well as the 200-day moving average. But a nice rally so far off of support for financials. We're going to take a quick commercial break. We're going to be back with my guest, Chris Ciovacco. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, get your questions to us anytime. The Final Bar at StockCharts.com is the best way to get a hold of us. We'd love to hear from you and answer your questions as you try to navigate these markets. I want to bring on my guest, Chris Ciovacco. I met Chris when I was down in Atlanta, back when we could travel. I remember sitting down with Chris and enjoyed so much learning about how he thinks about the market. It's just a great, refreshing long-term perspective to put things into context. So Chris, I'm super happy to have you on the show to hopefully help us put all of what we're seeing into proper context. Welcome back to the show, Chris.
I'm glad to be here. And I've been watching the first 11 minutes of your show, and I'm very impressed. It's very, very enjoyable and it's good work.
Thank you for saying that. Now, we start with the chart of the S&P 500. I was just sort of, giving a rundown on what I was seeing. Give us your take on the S&P here. What are you seeing?
What I always like to say is we always have to remember charts are not just a bunch of lines on a page. That this is basically a reflection of human behavior. So if we start up at the February 19th peak in the S&P 500, and obviously we have a very sharp and rare drop down to the March 23rd low, that's kind of step one of the psychology piece of the puzzle here. And then when we move off of that low, mainly between March 23rd let's say Monday, April 6th. Monday, April 6th would be the 10th trading day off of the low. In our mind and in our time frames, that's where we start to switch to on Monday, April 6th. Hey, the low might be in. You're not at a point where the evidence is telling you the low is in, but there's enough on the table there to say it might be in. And the point of showing the chart is the human behavior patterns, how fast we fell, and what we've done since the March 23rd low can give us a lot of insight from a probability perspective about what the second half of the year might look like. And we can go over to the next slide. So as a money manager, I don't like the term forecasting. I like the term probabilistic forecasting. When you have capital at risk, I like to know two things. What's a reasonable upside expectation for the market on multiple time frames? So for us, that might be 2 weeks, 4 weeks, 6 weeks, all the way out to 5 years. And what's a reasonable expectation for drawdowns over those same periods? And usually you want to get a good handle on what's a maximum drawdown based on history that you could expect in the next 6 months. What we're looking at here is a study. So what does a study tell you? When you have some type of signal, so let's say it's a breath thrust. What is a breath thrust? A breath thrust is basically a sharp change in human behavior or a sharp change in the perception of future economic outcomes. And those are relatively rare. So when we see a date of a signal, let's say a signal occurs on April 20th of this year, we can go back and find the same dates where the same signal occurred. And what that tells us is human beings in the rearview mirror and human beings on the date of that signal, their minds were in a similar place. So if we understand what it looks like walking forward from the date of the signal, it can give us some idea of what we talked about. It's good to know what the future might possibly look like. It's good to know what my drawdowns might look like. So in tomorrow's presentation, we'll fill in the blanks on this chart here. And this is an example of that, where you're taking a signal, you're looking at how the market performed after the signal historically, and you can do some back of the envelope calculations and say, if the market acted in similar ways on the right-hand side of the screen, what might year end look like? And it's based on somewhat of a market wizard's concept of charts can't predict the future. So we have to use our own intelligence and draw our own conclusions in terms of what is the past activity of some traders telling us how other traders may act in the future. And when you get sharp and rare signals, that's some insight into human behavior. And we've been doing these studies for years, and I can tell you sometimes they are shockingly helpful and shockingly accurate. Going back to the point that they can't predict the future, something like the virus would be an outlier where a study like this is not going to be particularly helpful because market participants looking in the rearview mirror didn't know the virus was coming and didn't understand maybe the severity of it. If we go to the next slide, same concepts here for tomorrow. We're going to be looking at things that we can see that have happened in the rearview mirror, the actions of some traders. What might they tell us about the actions of other traders in the future? And the way that we can do that is with historical precedent. And we can do that with asset class behavior. We can do that with breadth thrusts. Rate of change is somewhat very, very similar to a breadth thrust. Sharp rate of change, once again, tells you that the net aggregate opinion of all market participants regarding all subjects on all time frames has flipped. And it's rare to get a flip that's as fast as what we saw at the bottom. And tomorrow we'll cover very specific instances of things that we've seen in the rearview mirror and give you some perspective as to when they happened in the past. And then you can draw your own conclusions about what that might say about the second half of the year.
Chris, what I remember so much about our conversation when we met in Atlanta and interviewed you for Behind the Charts was I remember how much I enjoyed our discussion about thinking about investor psychology and how they are making decisions, but the benefits of analyzing history to really see how they've behaved. And it sounds like that's what we're going to get tomorrow for your presentation. I'm super excited for it. And as a reminder for everyone, that's coming up tomorrow, 10 a.m. Eastern on StockCharts TV. Chris Ciovacco, thanks so much for coming on the show. I really appreciate it.
Glad to be here and keep up the great work. Really enjoying the show.
That's Chris Ciovacco from Ciovacco Capital Management, based in the Atlanta area. I met Chris. It feels like so long ago. It was earlier this year when we traveled through Atlanta and had such a good conversation. I'd followed some of Chris's work on social media, and I will tell you, picking his brain as an investor and how he thinks about market history is way better than what you will get from his work on social media. He's just a very, very thoughtful investor with some really good information and statistics to back things up. So his presentation is coming up tomorrow as part of our week-long experience on StockCharts TV called Charting the Second Half. So check that out for sure. I want to go on to our next segment called Banking on Breadth. So we've talked about breadth characteristics, and as you know from watching the show, hopefully, I refer to breadth pretty often. I think of the macro piece of the puzzle in three parts: price, breadth, and sentiment. So number one, and that's in priority order. Number one is price. What is the price doing? If the price is going up, I in general want to be overweight or owning that. If the price is going down in general, I'd want to be leaning away from it or underweighting it or away from it. And that's the basic premise for trend following and how I've learned to think about investing as a longer term investor. The second piece of that, though, is breadth and trying to qualify, trying to augment what you can see in the price by looking one level deeper and seeing what sort of themes emerge, what sort of patterns are on individual names and groups and sectors. And when you compare that to what you see in the price, a lot of times I have found that turns, especially inflection points, major rotations, will often be reflected in the breadth characteristics before they'll be reflected in the price itself. Because at the end of an extended bull move, we will have a rotation away from speculative plays into more conservative mega cap stocks. As a result, the indexes hold up while the individual names will start to roll over. So breadth will get weaker before the price of the index itself will. So breadth is an important piece to what I do. What we like to do occasionally is review the breadth indications, where they're at and what we're looking for. So let's start with a chart of the S&P using breadth in the form of the percent of stocks above their 200-day moving averages. We're going to do that for the New York Stock Exchange on the second panel. On the bottom panel, it's using the S&P 500. And I tend to use both of these. It's sort of like looking at the S&P and then looking at a broader index of stocks. You just get a different flavor because it's a larger universe and because these are equal weighted measures, because it's just looking at the simple percent of names, not by cap weight, but just by equal weight, how many of them are above or below. It sort of takes the weight of the mega cap stocks out, focuses more on what the sort of the average stock is doing, what individual names are doing. So a couple observations here. Number one, we focused and we've talked a lot about how this indicator, looking at the percent of stocks above their 200-day moving average using the S&P 500, has remained below 50%. It spiked above it. This was after that last test of the current levels that we're at. And then we very quickly went down below. And in general, if you look back on this chart for the last 20 years almost, you'll see that in general, bull market phases, cyclical bull markets, this indicator tends to remain above 50%. In cyclical bear markets like 08, 09, like the pullbacks in 2010, 2011, 2015, 2018, and 2020, the indicator goes below 50%. We've overall remained below that level. I think, given the action that we're seeing this week, we're very close to seeing this indicator rotate back above 50%, which would be, in my opinion, something to certainly validate the potential for further upside. But until we do that, it just tells you that overall more stocks are still in a downtrend based on that simple in the New York Stock Exchange have that similar characteristic. So there are more S&P names above there. If you look at that universe, more within the S&P versus the broader New York Stock Exchange, sort of backing up that idea that the mid, small cap types of names, are still sort of more in a downward phase. On the second chart, we're going to zoom in a little bit, just looking at the S&P 500. This is that same indicator, percent above the 200-day, and at the bottom, it's the percent above the 50-day moving average. So a little, a shorter term measure. What's interesting here is that it's pulled back from almost 100% of stocks the first week in June. This is the last time we faced, S&P 3230 or so. We're retesting those levels, but now only 70% of stocks above their 50-day. So, less names have been pushing back higher above their 50-day moving average, which is a pretty, short-term but interesting, maybe medium-term measure of trend. So this next time we approach this same resistance level, less and less stocks sort of participating based on this and this alone. If this starts to break above the swing highs from the beginning of July, if we get above 50% on the percent above the 200-day, I think this starts to certainly back up more of the bullish configuration that you might expect. In terms of advancers, decliners, and again, this is going to update a little bit as we sort of lock in the closing prices for the day, but by the current read, just over 80% of stocks higher today. What's interesting is over the last 2 weeks, you can see there's been an increasing number of stocks closing up on the day, a decreasing number of stocks closing down on the day. So it's certainly illustrated that, based on day-to-day trends, more and more stocks closing higher than lower. In terms of new highs and new lows, very little to speak of. But if you look overall, it's kind of hard to see the trend because the down move that you saw in March in terms of new lows really skews the range here. But overall, there's been slowly and steadily an increasing number of names within the S&P 500 that have closed, that have made new 52-week highs. To believe in further upside, to believe in the S&P retesting 3,400, I think you need to see leadership names breaking to new highs. We haven't seen enough of that, I think, to really believe that that's happening, but that's something I would be looking at. I color code the cumulative advanced decline lines in a very subjective fashion based on just what I see the trends being. And I think what I've noticed is this divergence between the largest companies and the smallest companies. And the cumulative advanced decline lines on the S&P has made a new swing high this week, while the small cap one is nowhere near that. Now, on a day like today, you're certainly going to see the advanced decline lines chip away higher. This isn't updated for today's close just yet. But overall, I think the trend over the last 3 to 4 weeks is what I'm focusing on. That's certainly indicating mega caps over small caps, with mid caps sort of in the middle. We only have maybe just a little bit more time. Maybe the last thing I would look at is the McClellan oscillator in general. When this is above zero, it's a different way of making sense of advanced or decliners. It uses some moving averages to smooth out the signals. When this is above zero, it tells you it's more of a bullish configuration based on that breadth measure. Below zero is more negative. It'd be interesting to see if this can rotate above zero. That would put it more in the range that it was in back in mid-May to early June, which was the last time we had a nice thrust higher in stocks. That's our quick look at breadth. And again, overall, it's sort of, neutral to positive is how I would maybe summarize it, but it just depends on which measure you're looking at. And I think that's where it's sort of how this market feels. It's overall nets out to about a neutral. You have some positive, some negative. Again, if some of these start to turn positive, especially this chart looking at the percent above their 200-day and 50-day, that's what I would be looking for. We need to wrap this show and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the FANG Plus Index. This is an index we've referred to before. It's $NY FANG, and this includes the traditional FANG names, but also other stocks like Twitter, Baidu, I want to say. It's some of the Chinese internet names. It's sort of a basket of 10 to 12 stocks, if I remember right. So it's the FANG and FANG-like stocks representing that overall trade. The reason why I want to start with this chart is I know there's been a lot of talking, especially me on Monday, thinking, wow, huge rotation in the mega cap tech trade, which is absolutely right. Some potential for further weakness, that is absolutely right. But it is still very early on in that sort of thesis. This index is overbought. It's come out of that overbought region. It's still on a relative basis up huge relative to pretty much anything else you could compare. So if it is a sell-off from here, these are very much the early innings of something like that. We haven't really gotten any confirmation of a breakdown. I would be looking for some of the swing lows and previous pullbacks on that index in particular. Let's look at two other stocks within that basket, sort of that FANG trade. Amazon is number two. We talked about consumer discretionary and how there is a mixed bag of that sector. Sector is a very diverse sector with a lot of different types of companies, with a lot of different chart patterns for sure. Amazon has come off pretty good off of the high. We have the bearish engulfing pattern, continued lower today, so down over 2% today on a day the market was up 1%. So the relative strength certainly coming off a little bit. This is why the consumer discretionary sector as a whole, the XLY, is coming off a little bit. But if you look at the individual names and groups, there are stocks within the sector actually holding up pretty well. So remember, consumer discretionary is not just Amazon. Chart number three is looking at Apple, and I think it's worth noting that even in this, quote unquote, mega cap tech trade in trouble, which I totally get, also worth noting that a stock like Apple just continues to make new 52-week highs, which it did on a closing basis again today. So up a little less than the market, up 0.7%, but that's still a new closing high for the year plus. So there are stocks still chipping away higher. They are mega cap names that are doing it, which is why overall a stock like Apple going higher, Amazon going lower, those sorts of things net out. And that's why the market sort of still chipping away, facing that key resistance level we'll have to look at in the coming days. Folks, that's our show. Thank you so much for joining us on the final bar. I want to thank my guest, Chris Ciovacco from Ciovacco Capital. Check out his special on StockCharts TV tomorrow, Thursday at 10 a.m. Eastern. Also, all the rest of the Charting the Second Half lineup. For StockCharts.com and Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.